Volatility simply means how much the price of something, like a stock or an investment, goes up and down over time. The more the price moves and the faster it changes, the more volatile it is. If something is highly volatile, its price jumps around a lot. One day it's worth more, the next day it's worth less, sometimes by a big amount. If something is less volatile, its price stays more steady. It still changes, but more slowly and with smaller movements. Let's look at a real-world example. A clear example of market volatility is the COVID-19 crash in early 2020. S&P 500 dropped by 35% in just a few weeks as panic set in. However, by the end of the year, the market had fully recovered and finished with a 74% gain. This shows how short-term volatility can be unsettling, but long-term investors who stay patient often benefit from market rebounds. Let's look at another example. Let's say you invest £100 in 2 different stocks. First, you buy shares in Tesla. The price jumps to £110, then drops to £90, then climbs back to £105, all within a few weeks. That kind of up and down movement, that's high volatility. Now take the same £100 and invest in Procter & Gamble. Over a few months it grows slowly, £102, then £104, then £106. It's still going up, just more steadily. That's low volatility. Volatility is not the same thing as risk, but they are connected. Risk is about the chance of losing money. Volatility is about how much prices change, whether up or down. The more unpredictable the price, the more chance it might be low when you want to take your money out. That's why people sometimes think volatility feels risky. But here's something really important. Volatility is normal, all investments go up and down, that's just how markets work. Prices change based on news, the economy, interest rates, and even people's emotions. Some days investors are hopeful, other days they panic. Prices reflect all of that, and that's okay if you understand what's happening. The problem is when people don't expect it. They invest money, see the value go down a bit and think, I've lost money, so they pull it out. But often if they'd just waited, the value would have come back up. That's why a long-term mindset in investing is so important. When you give your money time, years, not weeks, it has a better chance to grow, even with the ups and downs. Here's a simple way to picture it. Imagine you're walking up a hill with a yo-yo in your hand. The yo-yo goes up and down the whole time, sometimes quite a lot. But while it swings, you are still moving upwards. That's what investing looks like with volatility. There are short-term drops, but the long-term trend can still go up. So what does this mean for you? If you're saving for something that's years away, like retirement or building wealth, volatility shouldn't be something to panic about. It's an inevitable part of the process. Markets will go up and down over time, but the key is that, over the long run, they tend to trend upward. When you're focused on the long term, those short-term fluctuations don't matter as much. Instead of worrying, use volatility to your advantage, stay consistent, and let time work for you. But if you're saving for something in the near future, like a house deposit in the next year, you'll want to be more cautious with high volatility investments. Since your timeline is short, you might not have the time to recover from a market dip if you need the money. Instead, some people look for more stable investments with less price movement, aiming to have their money grow steadily over time. Understanding volatility helps you stay calm when prices bounce around. It gives you confidence to stick with your plan, even when the market looks shaky. Volatility simply means price changes. It's noisy, sometimes dramatic, but totally normal. And once you know what it is, you don't have to be afraid of it. The real key is to plan for it, not panic because of it. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.